Morning, how are you? Okay, folks. So I think I got the last case back about 20 minutes ago. There were like 3 stragglers that I hadn't got to that finally I found. So I think everybody should have their case back. So if you're one of the 5 or 6 who did not get it back, it's probably because that last case went out. Okay? And as I said, in the front of the case, you see the grade, you see, the 3A, 9B, 9C. I mean, that's the best way I could figure out of how to make it clear about where the points got lost. And if I've missed something on your case, if you feel that there's something you did where I've taken points off, just bring the case in. I'll take a look at it. Right? Reminder, your second quiz is day after tomorrow. Right, so you need to let me know before 10:30 day after tomorrow if you're not going to take the quiz. There will be a review session tomorrow in 260. It will be recorded and webcast. So basically, if you can't make it from 12 to 1, obviously you can watch the webcast. But it will cover everything in packet 1 from last parts of beta, the very last vestiges of beta to the end. Which is a lot of stuff, right? Because essentially it is everything you did on the case. And that's why I said if you kind of were involved in the case and you had your hands dirty, you knew what you had to do, and you looked at what we did in class, I wouldn't say you're okay, but that's about as prepared as you can get, right? One thing, and this I'm going to make a plea because I'm not going to come back and cut you some slack for this. If you have a financial calculator, figure out how to use the present value button, please. Because if I give you 5 years of cash flows, I don't want to see 5 separate cash flows. I know it works, but it's going to suck up time for no reason at all. So figure out how to do and if you have a scientific calculator, figure out how to do the equation for the present value of an annuity. Because otherwise you're going to be wasting 5, 6, 7 minutes of 30 minutes just working through numbers. So let's start with the next phase of corporate finance. Up till now we've talked about the investment, the hurdle rate process. Let's talk about the second half of this class. So if you think about where we are, we've talked about how to come up with the hurdle rate. And the hurdle rate we said should reflect the riskiness of what you invest in. And we talked about how to measure that risk. With equity, we measure the risk as the risk you cannot diversify away, captured with a beta. And with debt, we said we measure the risk with default risk, which we capture with the default spread. Those go into a cost of capital. The weights reflect the mix of debt and equity used. That was the first quarter of the class, coming up with the hurdle rate. Then we turned our attention to coming up with returns, and there we emphasize returns are based on cash flows. Those cash flows should be incremental. They should be time weighted. And all side effects, synergy, whatever benefits or costs you have, should be brought into that net present value. There's no garnishing allowed. Today's session, I want to start on the financing principle. So let me review again what the principle says, and then we'll talk about what today's session is going to be about. The financing principle says find the right mix of debt and equity for your company. Notice how I phrased that. It's not the right mix of debt and equity for every company, the right mix of debt and equity for your company. And we said that mix of debt and equity should maximize your value as a business. So that's the part of the discussion we're going to start on today. And once we're done with that, we're going to talk about what's the right kind of debt for your company. Now, before we even start this discussion about how much to borrow, you have to recognize that borrowing money is never completely a financial decision. And here's why. If you think about every religion in the world, and you go through the ages, and you think about what they feel, think, say about debt, every religion in the world, how do they view borrowing money? Is it a good thing or a bad thing? Almost every religion, it's viewed as a bad thing. In fact, if you're a borrower, you're considered weak. You've sinned. But if you're a lender, God help you, right? Because every religion, the wrath of hell is on the lender's side. You charge interest. So through time, this thing worms its way into your mind. When you think about debt, it's never quite a financial decision. So when you say debt is bad, that might sometimes be coming from something else in you rather than the trade-off. So today I'm going to set aside whatever religious convictions you might have against debt and talk about the trade-off. But at the end of the game, I'm going to recognize that if you run a company, you're the manager, you're the CFO, you're the owner, how much you borrow will depend very much on that, how well you can overcome that barrier to whether you think debt is good or bad. So let's set the process up by starting with a very simple question. A question we kind of examine in the context of cost of capital, but I want to make sure I re-examine now before we embark on how much should you borrow. So let's start off by looking at the distinction between debt and equity. What makes them different? And I'm going to go through a series of things that I would look at to classify something as debt, and then look at the same things for equity and see how they're different. So this half the class B debt, and this half the class, or this 2/3 of the class B equity. If you're looking at debt, here are some of the features generally that you would see for debt. The first is the claim is usually a fixed claim or at least a contractually set claim. The reason I'm stepping back from the fixed is if you borrow floating rate debt, the payments you make every year might not be fixed, but the way you have to make those payments is structured up front. So it's a contractually set claim. Usually in much of the world, it's tax deductible. That kind of plays a role in whether you borrow money. If the company gets into financial trouble, you get first dibs on the cash flows. So basically, as the lenders, the cash flows go to you. Generally speaking, debt comes with a finite maturity. So when I borrow money, the bank doesn't say, forever debt. Usually it's 20-year debt, 10-year debt, 6-month debt, 3-month debt. And generally speaking, when you lend money to a firm, you take no role or very little role in how the company is run. So if you're a debtor, you get a fixed claim, you get first claims in terms of company being in trouble. You generally don't take any role in the management. When you look at equity, here's what characterizes equity. The first is you get a residual claim. You get whatever's left over after everybody else. You're the last person in line. Second, that cash flow to equity in much of the world is not tax deductible. So when you take that cash flow out of the business, it has to come out of after-tax cash flows. Third, it has the lowest price. So you're the last person in line if the company liquidates. If there's anything left over, you get this. And generally speaking with equity, there is no finite maturity date. It's not like when you invest in equity, somebody says at the end of 30 years, you're going to get your money back. It's essentially for as long as the business keeps going and you get to run the business. So there's equity and there's debt. And the reality is that every business, no matter how small or large, every business either borrows money or uses equity. What they get called will vary across businesses. If you have a small private business, what you call equity will be your own savings. And what you call debt might be a bank loan. If you're a big corporation, what you call equity might be public shares that you issue, and what you might call debt might be corporate bonds. But debt and equity are ubiquitous. You run a business, there is something on your balance sheet that I'm going to call debt and something that I'm going to call equity. So I'm going to start off with a few basic facts about debt and equity around the world to kind of set the table. This is actually a very old study, but much of what you see in the study is still true. What the study looked at was what percentage of the capital raised in companies around the world comes from debt and equity. So basically when you say net equity, net debt, and internal financing is retained earnings. Net equity is new equity issues, net debt is new debt issues. So basically if you think about three ways of raising money, you can use retained earnings, you can issue equity, you can issue debt. So if you look at Canada, for instance, the breakdown is about 40% comes from retained earnings, about 40% from net debt, about 20% from new equity issues. You go to the UK, about 50% from, so basically you can see that. And then you look at the US, and what do you see? The net equity is a negative number. You're saying, what does that even mean? Why is the net equity in the US a negative number? Because when you buy back more shares than you issue, your equity is actually shrinking. And for much of the last 20 years, equity in US companies has essentially gotten smaller. The buybacks each year, last year for instance, collectively US companies bought back about $600 billion worth of equity. They issued about $100 billion of new equity. That's probably an understatement because the IPOs, if you add on, it's probably 250 or 300 billion. But net, the equity in the US actually shrunk by 300 billion in terms of cash returned versus new stock issues. Don't jump to any value judgment, say that's good, that's bad. For the moment, just state it as a fact. We'll come back and ask, does that make sense given where the US is in terms of the life cycle? The other very interesting feature of debt in the US versus the rest of the world, and this was more striking 20 years ago, is US companies are much more dependent on corporate bonds for raising debt than the rest of the world. In fact, 20 years ago, US companies used to issue bonds, but if you're European companies, Asian companies, you generally used only bank loans. So corporate bonds and bank loans. In fact, while we're on that topic, if you're a company going out to borrow money, which is the better way of raising money? Is it better to issue corporate bonds or is it better to issue bank loans? And what's the trade-off? Okay, let's start with bank loans. What's the advantage of using bank loans? Well, if it's already lower interest, then I'd use bank loans every single time, right? So why would a bank charge you a lower interest rate than corporate bondholders would? Okay, but you can secure corporate bonds as well. So if that's the reason, then we can, because if I take bank loans, so let's say I want to borrow $500 million against my assets, and I decide to use the first $100 million as secured, then I go down the ranks. And if I look at the average interest rate across the $500 million, whether I use bank loans or corporate bonds, I'm backing it up with the same class of assets. So collectively, the interest rate on bank loans can't be lower. Yes? Well, that's true. You can make it, but bank loans don't have to be term loans. You can have balloon payment bank loans. You can have term loans. That trade-off is between you and the bank. You know, so that by itself is, basically it's just a different set of cash flows. Yeah. The first is when you borrow money from the bank, you can actually convey information about stuff that you can't convey to the market. So let's say you have projects that are just on the verge of paying off. You're a biotech company and you're on the verge of having a blockbuster drug approved that nobody seems to know about. You can convey that information to a bank and perhaps get a better interest rate than trying to issue bonds. So the first advantage of bank loans is you can get this private information. What's the disadvantage of using bank loans? Let's say you go to a bank and say, I'd like 15-year floating rate convertible debt. What's the bank going to say? Well, we issue only 3-year straight bonds. That's it. Take it or leave it. So bank loans are not as flexible as corporate bonds. I can do all kinds of neat stuff with corporate bonds because there are buyers who will buy those bonds. So bank debt has this advantage of supplying information, but it's the disadvantage of being rigid. And if banks start to freak out about risk and they refuse to lend money, you're kind of stuck. Corporate bonds are more flexible. You can structure them differently. But here's the fact that you cannot argue with. It's better to have both options than only one. Why? Because you as a company can decide what's right for me. And if you look at US companies, there are very few US companies that issue only corporate bonds. Even the biggest ones. They will have some bank loans for some of their debt. So clearly on some of their debt, they feel they're better off using bank loans and others corporate bonds. Prior to the 1990s, outside the US, companies had no choice. You either borrowed from the bank or you didn't borrow at all. Now those choices are starting to open up, and you can start to see this when I take my firms and show you what kind of debt they have. So these are my companies, so I'm going to take each of them and essentially look at how much debt they have and in what form. So let's start with Disney. Disney has about $13 billion in interest-bearing debt in market value terms and about $2.9 billion in lease debt. Remember how we capitalize leases to make them debt? So it has about $2.9 billion in debt. Vale has about 41 billion in interest-bearing debt, about 1.2 billion. This is November of 2013. 1.2 billion in lease debt. Tata Motors has 477 billion rupees in traditional debt and 0 rupees in lease debt. And finally, Baidu has about 15.4 billion in traditional interest-bearing debt and 3 billion in lease debt. So you can see the breakdown varies across companies. If I'd done a Walmart or a Target and I'd put it over there, you know what you'd have seen that would have made it stick out? Most of the debt would have been lease debt. So if you're looking at retailers, restaurants, the composition of your debt is going to be different. Now let's look at what type of debt they have. Not surprisingly, Disney has the most corporate bonds. 92% of its debt takes the form of corporate bonds, but even Disney has about 8% that's bank loans. As you go across, you're starting to see how corporate bonds are starting to become more usable outside the US. Both Vale and Tata Motors have a significant portion, not as much as Disney, of corporate bonds. And I'll wager if I track these companies 10 years from now, that proportion is going to increase. It's almost a given that corporate bonds are going to become a bigger portion of debt outside the US because now you have a choice you did not have before. And finally, when you look at Baidu, all of their debt is bank debt. Let's break it down by maturity. If you look at Disney, about 49% of their debt is between 1 to 5 years. And remember what we said about the right kind of debt for a company? The right kind of debt for a company is what? How do I decide what maturity to use, what coupon to use? What should I look at? What kind of assets I have, right? So as I go through each of these companies, I'd like you to think about whether the debt I'm describing makes sense for the company. So for Disney, I'm getting a lot of short-term debt, 1 to 5 year debt. And I'm getting a small portion that's really long-term debt. So I know we're hypothesizing here. What are Disney's biggest businesses? What is its biggest business? Broadcasting, right? 50% of Disney's value comes from broadcasting, and a very big chunk of that comes from ESPN. What kinds of projects do you take in those businesses? My guess is 2, 3, 4, 5 year projects. So it does make sense that a big chunk of their debt is 1 to 5 years. So how do you explain the 13% that's really long-term debt? What's the one business? The theme parks, the Shanghai theme park, the Hong Kong theme park. So basically the theme parks have really long lives. So that's subset. So I don't know whether that's true, but it does look like the maturity makes sense given the kinds of assets they have as a company. Let's take Vale. A big chunk of the debt the biggest chunk is actually really, really long-term debt. What's a typical project for Vale? An iron ore mine. An iron ore mine has a life of between 25, 30, 35 years. Again, we're hypothesizing, but looking at their assets, roughly speaking at least, it looks like the maturity makes sense. Tata Motors, the bulk of their debt is between 5 to 10 years. Part of that can be explained by the business they're in, but part of it also can be explained by the fact that until about 10 years ago, all their debt came from Indian banks. And Indian banks don't lend for 30 years or 50 years. You're kind of stuck with 5-year debt, 7-year debt, 10-year debt. So my guess is some of this reflects the business they're in, and some of this reflects the kinds of constraints they faced when they went out to borrow money. In fact, I used to look at Brazilian companies 20 years ago, and almost every Brazilian company, we looked at their debt, had 2 to 3 year debt, no matter how long-term the assets were. And the reason was very simple. It's not because they wanted to take 2 or 3 year debt, but when they went to a Brazilian bank and tried to borrow money, no Brazilian bank would ever lend them money for longer than 2 to 3 years. And finally, when you look at Baidu, you have a lot of short-term debt, 69%. What's a typical project for Baidu? It's a search engine. It's a technology company. Projects are pretty short-term. So again, at least in terms of maturity, it looks like what the companies have makes sense. Let's break it down by what currency the debt is in. Disney has about 95% dollar debt, 5% foreign currency debt. So here's a question. It's a kind of a generic question. I think you already have a data point that you can use to answer this question. Do they have enough foreign currency debt? What would I compare the 5% to make that judgment? Remember when I did the equity risk premium for Disney? What did I do? I broke down their revenues into revenues from the US, 82%, and revenues from outside. I know it's a very rough statement to make, but if 18% of your revenues come from outside the US and I see only 5% of your debt that's foreign currency debt, I'm going to push back and say, why isn't there more foreign currency debt? Maybe you have a really good reason. but it looks like Disney has too little foreign currency debt. If you look at Vale, 65% of the debt is dollar debt. It's not just foreign currency, but it's dollar debt. Does that make sense for Vale? They're a Brazilian company, I thought. Or are they a Brazilian company? They're a mining company that is incorporated in Brazil that gets its revenues all over the world. And one of the things about commodity markets is when you pay for commodities, you pay in US dollars. So basically, you have dollar revenues. So at least roughly speaking, it does make sense that most of their debt is, in fact, foreign currency debt. If you look at Tata Motors, about 71% of the debt is rupee debt, 29% is foreign currency debt. In 2008, if I'd shown you that, you'd have said that makes no sense. Tata Motors is an Indian company. In 2013, why does it make sense? Because they have Jaguar Land Rover. In fact, my guess is they probably have too little foreign currency debt. Given that Jaguar Land Rover is getting bigger and Tata Motors domestically is getting smaller, I would expect to see that foreign currency debt become larger. And then you get to Baidu, and you get a breakdown of debt of 18% local currency, 82% foreign currency. Where does Baidu get all of its revenues? Well, let me phrase it differently. Have you ever talked to anybody outside China who's ever used Baidu? I haven't. This is a purely Chinese search engine. All of its revenues come from China. And if you stay true to the notion that you should be matching debt up, this actually makes completely no sense. So later when we come back and talk about debt, we might say, what can we do to because this is a problem. You might say it's a small problem, big problem, it depends on what you think will happen to exchange rates. But any time you mismatch the debt to your assets, you have a problem. And clearly at this point, Baidu has too much foreign currency debt given where they get their revenues. Which brings me to the last component I looked at, is how much of the debt is fixed rate debt, how much is floating rate debt. Is everybody comfortable with how floating rate debt works? Fixed rate debt, you're clear, right? When I go out and borrow money, you set the rate, it's set for the next 10 years. When I borrow money on a floating rate loan or a floating rate bond, how does it usually work in terms of interest payments? So the first year, I know what the interest rate is. What happens in the second year? It's a floating rate loan, so the interest rate will get reset, right? Reset to what? There's usually some basis on which the interest rate is set. It could be the 10-year bond rate, it could be the prime rate. It used to be the LIBOR rate until people stopped trusting it. Something to build off. So if rates go up between now and next year, on a floating rate loan, your interest payments are going to be higher. But they're going to be predictably higher, because I'll tell you how much of a spread I'm going to charge over that. So in a floating rate loan, my rates move over time. Later in this class, we're going to talk about when does it make sense for a company to issue floating rate debt. But at least for the moment, let's look at the breakdown. For Disney, 94% of its debt is fixed rate debt, about 6% is floating rate. For Vale and Tata Motors, all of the debt is fixed rate debt. And for Baidu, it's very similar to Disney, 95% fixed rate, 5% floating rate. None of the companies seem to use floating rate debt very much. Maybe it makes sense, maybe it doesn't, but that's a discussion for another day. We'll come back. So one of the things we will do when we talk about what the right kind of debt for a company is we will take these companies and break down the debt and say, is this the debt I would expect to see in the company? And if there's a mismatch, we'll talk about what to do next. So let's think about how much you should borrow. And let me use that corporate life cycle that I've used on the other aspects of corporate finance to kind of talk about it, because this is the simplest way I can think of whether you should borrow money. Remember, in a corporate life cycle, you have a startup, it's like a baby, then you got the teenagers, which are the young growth companies, then you got a peak of the growth companies, and you become a mature company, and then you go into decline. So I'd like you to think about one company in each phase, or I'll throw one company at you in each phase. Let's start with a startup. Young company, very young company. Let's take Snap, right? It's pretty close to being a company where there's nothing there. So let's keep this simple. How much should you borrow if you're Snap? Come on, don't think too long. Go with your gut. If you're Snap, you should borrow nothing. Why not? You don't have the cash flows to service the interest payments, and the bulk of your value comes from where? Growth assets. Why would you want to risk all of that value by going out and borrowing money from a bank and then being held accountable for the fact that you couldn't make the interest payment? The bank takes those growth assets away from you. if you're a young growth company, don't even talk about debt. But the reason I think so many young startups end up borrowing money is when you go out and raise equity as a young startup, what form does it take? You're a startup, you're not public yet, you have to go to venture capital. What does a venture capitalist ask of you? He pulls a Kevin O'Leary on you and says, give me 50%. And you don't want to. This is your company, this is your baby, you don't want to give up equity. So what do? You imperil your entire company to make sure you own 100% of a crappy company that's going to go bankrupt. I'd much rather have 70% of a company that survives than 100% of a company that goes bankrupt. But this desire for control is sometimes so strong that owners of young startups don't want to give up equity. And what do? They put themselves at risk. Yesterday I was watching a Shark Tank episode. Young startup comes on. I don't know whether you watched this. Kevin O'Leary offers them this 3-year loan at 9%. So they wanted $750,000 for 4%. He offered them a $750,000 loan at a 10% interest rate for the next 3 years for 2.5%. So you can see the owner saying, I'm giving up only 2.5%. And they actually took the loan. I thought it was one of the stupidest things I've seen people do. Because what have you done? You borrowed the money, you've agreed to pay 10%, and if you fail to pay it, it's not like Kevin's going to say, you know what, guys, that was just bad luck. He's going to come after the rest of your equity. You've imperiled your business. Why? Because you don't want to give up 1.5% of your equity. So I'd suggest watching some Shark Tank, because you see these licensing agreements, because licensing agreements are pretty much the same thing, right? Fixed payments in return for less equity. So if you're a startup, don't even think about using debt. Desperation might drive you there. If it's a startup, it's a private business, you can't approach venture capitalists, you need to survive. But desperation-driven debt is not the same thing as sensible debt. So if you have to borrow money because you have no other choice, I can understand. But if you have a choice, I'd much rather you give up equity and raise equity as a startup. You're a young growth company. What should you do now? Your potential and promise is now starting to show up as revenues growing 150% a year. Are you ready to borrow money now? Your revenues are growing. Are you starting to make money yet? Maybe, maybe not. But what do your cash flows look like if you're a young growth company, even if you start making money? Every dollar you make plus more is going back into the business you're trying to grow. This is not the time for you to borrow as well. Then you become a growth company. And what happens when you're a growth company is your revenues continue to grow, but they're growing at a slower pace. You're saying that's bad news. The good news is you start to make money finally. So you have profits. So if you just look at your income, you say, I should be able to borrow money now. You might still hold off because you're still a little, but you're going to see as you become older as a growth company, your potential to borrow money is opening up. And when it first opens up, what's your reaction? No, I don't want to borrow money. I want to be a growth company. Why? It's so much fun to be a growth company. Who wants to grow up? So basically these companies fight this, and the way it shows up is as these companies continue to grow and their debt capacity opens up, they refuse to borrow money and their cash balances start to rise. Does this sound familiar? I mean, you look at a Google, you look at an Apple, you look at a Facebook, you can tell when this is happening because the cash balance goes from 10 billion to 20 billion to 25 billion to 35 billion to 50 billion. You know the company can borrow money, but it's fighting it with every fiber in its being. Apple did it for a long time, right? Until what triggered their decision to borrow money. Left to themselves, the management would never have borrowed money. Carl Icahn showed up and said, you have too much cash, why don't you start borrowing money and give me some cash? They said no, but in a sense a fight was joined. That's when Apple started to borrow money. If you're going into investment banking or consulting, do you know what your prime candidates are for advice fees? It's companies that refuse to act their age. These are mature companies that think they're still growth companies. They wear hip huggers at 49, right? It's not pretty, but they know they still think they're 22. But that's your prime target. Those are your companies that you're going to approach, and you're going to be persistent saying, hey, you know what, guys, someday you're going to have to borrow money. We're ready for you. And initially they're going to say, no, we'll never borrow money. We're a growth company. And then Carl Icahn is going to show up, and hopefully you've left your phone number right there on the CFO's desk. He's panicked now, and he calls you, and you're ready. You have the debt offering ready to go. Say, it'll be there 3 minutes from now. I'll give you the debt offering. Companies that don't act their age. Then you become a mature company, and the fight's over. You've given up now. So basically, you say, I have debt capacity. I'm not going to grow. This is your, the golden age of debt. Basically, you borrow money, and then you go into decline. And you face a different challenge, right? Your company's shrinking over time. So as you shrink over time, what are you doing? You're liquidating businesses, the J.C. Penney's, the Sears of the world. You're using the cash you get from liquidation partially to return cash to equity investors and partially to pay down debt. So why should you return everything to equity investors? Because then you're going to put yourself in distress, because if you take all that cash, pay down equity, and your company's getting smaller, sooner or later you're going to hit that problem of I can't pay the debt. So it's almost like you got to shrink yourself proportionately to make sure you kind of wander off into the beyond. It's as a small version of yourself. Already I've given you a template for, if you look at your company and say, should my company be borrowing more money or less money? Forget about all the models and the tools and the techniques. Just think about where your company is in the life cycle. Look at its cash balance. That actually is a good indicator as to what's happening in the company. And look at what's happened to the cash balance over time. Is it increasing over time or decreasing over time? That should give you some insight into whether your company is a good candidate for borrowing money. Any questions on the life cycle perspective on debt? Yeah, go ahead. Yeah. The question is, can there be a rebirth for a company in decline? The answer is yes, and we know the names of the companies that have pulled this off, right? And of course, we write case studies about them. One of the most horrific things you can do is write case studies about companies that make it back to life. So we write about the Apples of the world in 1999, IBM in 19... You know why it's horrific? Because people read those case studies. Then they go to become CFOs and CEOs of companies like Yahoo. And they say, I can pull an Apple here. And who can blame them, right? Because in those case studies, the hero of the show is the CEO of the company, Steve Jobs. They make movies about the guy. Marissa Mayer, you've just come into Yahoo. You want to be the next Steve Jobs. You want movies made about you. I don't blame people for trying. But more damage is done by companies trying to recreate their youth than companies getting out of denial. There's nothing, and this is something I said at the start of the class. A company is a legal entity. There's no reason why companies should be sustained. The notion of corporate sustainability is meaningless. Do I want a business that is sustainable? Yes, but only if it's a good business. If it's not, I don't want my business to be sustained. I want to shrink and go away, because that capital goes to other businesses that are sustainable, that can create value. So I think it is possible that companies can make it back, but in the process of trying, more value gets lost because you throw good money after bad. Okay. So now let's look at the transitions that happen. Because as you look at that life cycle, those transitions are in a sense the periods where you have to adjust. This is like puberty for companies, basically, right now as you're going through. You start a business and it starts doing well. Your first transition will be when you approach somebody else for equity. Because when you first start a business, your equity is just your savings, your parents' savings, your friends' savings, until you have no friends anymore. But if your business succeeds, that's the first phase. And of course, that's the phase where you have to be willing to give up equity to a stranger, perhaps a bloodthirsty stranger, but a stranger who will supply you capital to grow. That's the first transition. You succeed with the venture capitalist. There's a second transition, right? Which is you decide to leave the embrace of the venture capitalist, if you can even call it that, or the clutches of the venture capitalist, if you prefer to use those terms, and you decide to become a public company. So the first transition is when you approach venture capitalists. The second transition is when you go public. And this used to be so clean 30 years ago. Because once you got to a certain size, venture capitalists could no longer sustain you. So once you got big enough, you went public. today's market, you've got this, you created this gray area in the middle between being a private business and a public company that allows companies to kind of roam in this gray area for an extended period. You know who I'm talking about, right? A company like Uber. 20 years ago, Uber would have been public about 2 years ago. You know what the most recent pricing for Uber is? What's the number that you see attached to Uber? It's about 70 billion plus. This is a $70 billion private company. There is no way there is enough venture capital money to keep this company going at 70 billion. So how has Uber been able to pull it off? What's allowed them to stay in this gray space and not get pushed into being public?
Big asset managers?
And let's name names here. Company like Fidelity, T. Rowe Price, they all want to be part of the game, not because they want to create young companies and make them grow, but because they're greedy. They don't want to be left out. So the first thing that's happened is people who used to invest in the public marketplace, their most recent investor in Uber was the Saudi sovereign fund, which doesn't invest in private businesses usually, but they're investing in Uber. And as long as public investors are investing, you get the best of both worlds, right? You're raising capital from diversified investors. So you don't have that total beta problem that we talked about. And you don't have to go public with all the disclosure requirements and having earnings reports every 3 months and having Travis show up on YouTube and have it blow up your stock price. Things that you don't have to worry about. So Uber is probably really happy that they're a private company now, because can you imagine being at the next annual report and the annual meeting and questions get asked about what's been happening with your latest Uber expeditions? So this is, I think, what's changing. And I don't think it's going to go away, because what's happened is there is this gray space now between VCs and public markets that's much bigger and much more navigable than it used to be. And that means private companies are going to stay private for a lot longer than they used to before they go public. So you become a public company. The next transition is when you first borrow money. And that might happen in 7 years. It might happen in 17. Depends on when you start making money and when your debt capacity opens up. And then there's a final transition. And this is the transition we fight, where you go from being a mature company to a declining company, where you start talking about bringing in Larry the liquidator, liquidating your assets and paying down your debt. Companies have transition phases, and they have a really tough time with every single transition phase. Okay? So one of the things to look at is when companies make these changes, which companies do it it's always going to be painful, but which companies do it with the least pain. Any questions about life cycles and transitions? Okay? So let's talk about how much a company borrows. And let's start with some basic statistics. If I ask you how much debt does your company have, lots of ways you can tell me how much debt it has. You can give me a dollar value. The problem with the dollar value is it tells me very little. So if you tell me my company is only $1 billion in debt, that might be a lot of debt if your company is worth only 1.1 billion. So dollar debt is usually meaningless. You've got to scale it to something. One way you can scale it is the total value of the company. You can divide debt by the value of debt plus equity. So $1 billion is very little debt if you're a $100 billion company, but it's a lot of debt if you're a $2 billion company. So one of the ratios you will see is dividing debt by equity, the debt-equity ratio, or debt by debt plus equity, which is the debt-to-capital ratio. And here's where you can get into trouble if you visit Yahoo Finance or Morningstar or even Bloomberg. You look up the debt ratio for your company on any of these. The number you will usually see reported is a book value debt ratio. You're saying, what does that even mean? They take book debt and divide by book debt plus book equity. Now already, as you went through the cost of capital, I'm assuming you're kind of caught up on the project, which is kind of completely unrealistic. But when you did the debt plus equity, that if you look at book value versus market value, you get very different numbers. So I'm going to tell you up front, from this point on, when you hear me say debt ratio, I'm always talking about market value, because frankly, I couldn't care less what your book equity looks like. The other way you can actually tell me how much debt you have is as a multiple of some measure of earnings or cash flows. The number that you most often will see is debt to EBITDA. A lot of people like to use this. What multiple? EBITDA, in a sense, is the rough measure of cash flow you throw off as a company. So they divide debt by the EBITDA, and the lower that number, the less debt you have. So basically, if you can pay off your debt with 3 years of EBITDA, that's a lot less debt than if it takes you 8 years of EBITDA. And many LBO guys actually have this as one of the rules of thumb. If your debt to EBITDA is less than 6 or less than 5 or less than 4, you're a good candidate, for borrowing more money. So debt is scaled to something because that's the only way you can compare across companies. So let's set up the question. So the basic question we're trying to examine here is, you're trying to decide as a business between borrowing money and using equity. And remember again, this is not a question that only public companies have to answer. In fact, I would argue that hot dog stand guy outside that I talked about in the very first class, he has to decide how much to borrow and how much equity to use. So the trade-off that we have to think about here is, what are the benefits of using debt and what are the costs of using debt? And in the process, we're going to see why some companies should be able to borrow a lot more than other companies. So I'm going to start off by dismissing some of the reasons you will see given for the use of debt right off the front, because they're just distractions. Here's one. One reason I've been given by companies for borrowing money is I've been told that debt is cheaper than equity. Is that true? Absolutely. Think about the cost of debt and cost of equity. Debt is always cheaper than equity. So you're saying, well, then why shouldn't I just go out and borrow more money? Because if the only reason you're borrowing is the interest rate on debt is 5% and your cost of equity is 10%, the benefits are an illusion, because what you're doing is you're taking the risk of the company and you're just loading up on fewer and fewer equity investors. So you have no tax benefits. And you go out and borrow money. You might think you're lowering your cost of capital, but you're just moving around. In fact, the analogy that is often given is, if you take a bottle of whole milk, and you count the fat in that milk. I don't even know how you count the fat in the milk, but there's some way to get it. And then you divide it up into non-fat milk and cream, and you count. You get exactly the same amount of fat. You just have moved the fat around. That's basically the way to think about borrowing money in a company at a lower rate. Is you're not getting a benefit. You're just making the equity investors bear more risk. So if you tell me that you're borrowing money because the interest rate on debt is 5%, the cost of equity is 10%, so that's not good enough, because you got to give me something more substantial. So here are the basic trade-offs on debt. And this is it. No matter where you go in the world, these are universal trade-offs. There are two big benefits for debt. One we've talked about over and over again. I'm going to come back and be more specific about it, and that's a tax benefit. And the second is that sometimes in some companies, borrowing money can make companies more disciplined about the way they take projects. Sounds completely outlandish, but there are some companies where making managers borrow money might make them more disciplined. Two big benefits of debt. The bigger benefit, of course, is the tax benefit. On the other half, the side of the ledger, you have three costs. The first is what I'm going to call an expected bankruptcy cost. No matter who you are as a company, you could be ExxonMobil with $60 billion of cash flows coming in. If you borrow money, you've increased your likelihood of going bankrupt from 0.001% to 0.003%. So there's an expected cost of bankruptcy you got to weigh. So I've got to become more specific about how I'm going to capture that probability that you could get into trouble and what happens if you do get into trouble. The second cost is what I'm going to call an agency cost. Sounds fancy. In econ classes, we use this word whenever we don't want to talk about substance. So I'm going to be very specific about what I mean by agency problems when you borrow money and how it shows up as actual cost for a company. And the third and final cost is when you borrow money, you give up some future flexibility. Remember the old saying, save something for a rainy day? If you're a company and you have debt capacity, it's nice to hold back on that debt capacity just in case you need it. For a great project, for a recession, for a downturn. So those are the basic trade-offs. I'm going to take each item and talk about what animates that item and how it might show up when you look across companies. Because remember, in your project, you have 5 or 6 companies. You're comparing across companies. I'll tell you up front, even before you look at the numbers, that some of your companies are going to have lots of debt and some are going to have no debt. And these are some of the questions you need to ask to say, does that make sense? Let's start with the tax benefits of debt. For whatever reason around the world, the tax code is tilted towards debt. And it's strange. Why? Because if you listen to any politician talk about debt and companies, what do they say? This is awful. You guys are borrowing too much money. And then what do? They write the tax code to encourage you to borrow even more money. And the way this shows up is when you have an interest expense, you're allowed to deduct that interest expense for tax purposes, which means you have less taxable income and less taxes. I mean, April 15th is coming up. I don't know whether you're doing your taxes. But if you're doing your taxes and you're lucky enough to own an apartment or a house, or unlucky enough to own an apartment or a house, depending on what that house has done, you get a mortgage interest tax deduction. Shows up in Schedule A. With the mortgage interest deduction, I report less than adjusted gross income. I pay less in taxes. So this is not just corporations. Across the entire economy, the system is tilted towards that. And the higher your tax rate, the greater the tax benefit to debt. Which actually answers two questions. One is, why do people who need money the least seem to borrow the most? Right? If you're really wealthy, your marginal tax rate is 44, 46, 48. We said in New York City, what's your marginal tax rate? Close to 50%. If you add up state and local taxes, you're going to borrow more than if you live in Florida or Texas and you don't have a state tax on. So if nothing else, a higher your tax rate, the greater the benefit to debt. And I'm pushing you to borrow more money, even if you don't need the money. And if you look across countries, you can see how this is going to play out, right? The marginal tax rates vary across countries. The highest marginal tax rate in the world today is in the United States. The marginal tax rate in the United States is 40%. The lowest, of course, a lot of competitors with the zero tax rate, but most of them are small islands that basically are there just for the tax benefit. But if you look at Europe, the marginal tax rate is between 25 and 30%. I think Germany is 29%. And if you look at Ireland, of course, it's 12.5%. Already you can see the implications. Let's say you're looking at airlines, and you have 6 airlines in your group. You've got Southwest, you've got United, you've got Lufthansa, and then you have Ryanair. You haven't looked at the debt ratios, I know. You might not even pick the companies, that's okay too. But let's say you get there and you look across the debt ratios of these companies. I haven't looked at the debt ratios of these companies in a while, but which of these 6 companies would you expect to have the least debt? Ryanair, why? It's not because they don't need the money, but because they get the least benefit from borrowing money. And you'd expect the US airlines to borrow the most because they get the biggest tax benefit. So I have 2 questions. One is, how do you explain this? Why is the tax code tilted towards debt? If every religion says debt is a bad thing, every politician says debt is a bad thing, we all kind of agree that debt gets companies into trouble. Why do we encourage companies to go out and borrow more money? I'm sorry? Does it? Because all you're doing is moving, well, because if you get bankruptcies, there are social costs that are picked up by our social welfare system, by the fact that people have unemployment. I'm not sure it helps the economy net. It might help some specific subsectors of the economy, right? Real estate might say, this is great, we're going to have a higher value. But there's no way you can tell me that having a tax benefit for debt somehow makes the economy a bigger pie. It just, I think it actually shrinks it a little bit. So what do you think is the root of this tax benefit for debt? When did it show up in the US tax code? US federal taxes are actually, I think the Supreme Court actually found them legal in like 1916 or 17. So corporate taxes in the US are of relatively recent origin. But if you could go back, maybe the 1880s, 1870s, when the tax code was first get rid, you know what the bulk of the US economy was? 60% of the S&P 500, even in 1916, came from one sector. Guess which sector? Railroads were 60% of the S&P 500. That's why when people compare, like the Schiller PE, when they compare the PE from 1871 to today, you would say, are you out of your mind? You're comparing the PE ratio for a railroad to a PE ratio for Facebook. How can they even be remotely comparable? You think, so what if it's railroads? So in the late 1800s, people accepted the fact that railroads were helping the economy grow by building out towards the west, right? So the original tax benefit of debt was put in to allow railroads to raise capital because equity markets were not developed yet and they wanted the railroad. So that was the original basis. That was what, 18 something? We're in 2017. So why is it still there? Because once bad things get into your tax code, they will never leave. We have an entire economy now built on the tax benefits of debt. Basically, I mean, In fact, there's been some talk this year of, with the tax reform, one of the things they're actually talking about, it, I don't think it will happen, but if it is actually taking away the interest tax benefit of debt in return for a much lower corporate tax rate. You know why it can't happen? Because if it did happen, it might be the best thing for the US economy in the long term, but for the next 5 years, you're going to have calamity because entire sectors, can you imagine real estate without an interest tax deduction? I mean, that might lead to a 30% drop in value. That's why I'm trying to sell my house as quickly as I can. So if you want to buy a house, buy it now. Because I'm afraid of, so you can see why moving away from a system that has a tax benefit from debt to one that doesn't has to be done. So if you're going to do this, you probably have to do it over a 10-year period where you gradually move away from the existing system. So that's the tax benefit of debt. The greater the tax rate, the greater the tax benefit of debt. Now I'm going to use this tax benefit argument to kind of focus in on the real estate business. Because in the real estate business, you actually have a very interesting bifurcation of how real estate businesses are structured. You can have real estate corporations that are like any other corporations. What does that mean? They make up money, they pay taxes, and whatever's left over they can pay as dividends, they can buy back stock. You have real estate corporations. And then you have real estate investment trusts, or REITs. They both are in real estate, but here's the difference. When you have REITs that were created in the early 1970s in the US, REITs actually don't pay taxes at the entity level. You see, this is amazing. Why isn't everybody a REIT? But in return for not paying taxes, what are they required to do? They're required to pay out at least 95% of their earnings as dividends. You see how the IRS thinks? You don't pay taxes, we'll let somebody else pay the taxes, because when those dividends get paid, somebody's going to get them as income. So the IRS will, so don't lose any sympathy for the IRS. So poor IRS, they're not collecting as much in taxes. They'll find a way to tax somebody in this game. But you have two very different entities here, real estate corporations and REITs. Given what we just talked about how much you borrow should be driven by your tax benefits of debt. If you look at these as standalone entities, so if I gave you the debt ratio for real estate corporations and the debt ratio for REITs, which one would you expect to have the higher debt ratio? I would expect corporations to have the higher debt ratio. The only problem with REITs is it's not that interest doesn't get a tax deduction, it gets it through your investors, right? And one of the more interesting things that happens in real estate is if you have lots of wealthy investors as a REIT, you actually borrow money, not because you get a tax benefit, but indirectly your investors do, because you now have to report less net income, less dividends per share. So it's actually a tricky process with master limited. These are called pass-through entities because the income just goes through. Deciding how much to borrow may no longer be a function of how much is my tax rate. You actually have to know who the investors in your company are. So remember that HDS page we spent for corporate governance? If you're a REIT or a master limited partnership, you might want to look at that page to see what kind of taxes do they pay, because that might indirectly reflect what kind of tax benefits you get. So any questions on the tax benefits of debt? Okay. So if you're looking across the world, you would expect US companies to borrow more than companies pretty much anywhere else in the world, purely based on tax benefits. Right? There are other things to consider, but purely based on tax benefits. Now let's look at the second argument for debt. Basically, the second argument for debt says, in some companies, managers, they're spending other people's money. So left to their own devices, there's no consequence to taking bad projects. And here's what I mean by that. Let's say you're the manager of an all-equity funded mature company. You have billions of dollars of cash flows coming in from your projects. You take a bad project. Who's going to notice? You just hide it under your good projects. It's other people's money. So here's what I'm going to make you do. I'm going to make you go out and borrow a ton of money. And you see, why would that make me more disciplined? Now that you borrowed money, what do you have to make as payments every year? You're going to make interest payments. Now if you take a bad project, what could happen? You might not be able to make those interest payments. A company might go bankrupt. You're saying, so what? You could lose your job. You see what I'm trying to do? I'm trying to make this pain personal. When you take a bad project, I want you to suffer with me. And this might be the only way. It's extreme. I call this the Volvo argument for debt. And let me explain why. Let's say it's 5 years out. You joined an investment bank. You moved up the ranks really fast. There's nobody above you. You get to the top. You're now a managing director. You move to the suburbs, I don't know where, 20 miles out. You buy a big house. You have 2 dogs, 2 cars, 2 spouses, whatever makes you happy. And every day, here's what you do to get into work. You live in a town with a train station, like mine. You live 5 minutes away from the train station. So every morning at 6 o'clock, you jump into your car, you drive to the train station, you park your car, you get on the train, you go into work, you work all day, you work all evening, you work all night. That's how you afford the 2 dogs, the 2 cars, the 2 spouses in the big house. 10:30 at night, you get off the train, you drag yourself back to your car. You're too exhausted to even walk. You climb into your car, you get ready. You live only 5 minutes away, but there's this traffic light, which if it turns red, it takes forever to. So you come up to the top of the hill, and just as you get to the top of the hill, the light turns red. It's 10:35. You really want to get home. You say, oh, drat. Those would not be exactly the words you use, but I'm censoring as I'm going along. And as you sit there watching the red light, illegal thoughts start to cross your mind, right? So what if I ran that red light? Now, there are 2 things you worry about when you run red lights. One is getting a ticket, but these are the suburbs. The police have all gone home. You're not going to get a ticket. The other thing you worry about is getting hit. So here's where I have to give you some background. You have 2 cars. The first is a Volvo 960 Extra Armored. You know what I'm talking about? Front airbags, top. It's like driving a tank around town. The second is some kind of a tin trap. I don't want to insult any of your cars, so let me pick a make that I'm sure nobody. It's a Yugo. Antique Yugo. It shakes when you get in. When you drive, things start flying off the car. Your first day, it's a lucky day. You're driving your Volvo, you came to the light, and those illegal thoughts crossed your mind, and you're worried about what will happen if somebody hits it. Then you remember you're in your extra armored Volvo. If somebody hits your car, you get a little dent on the side. The other guy's all crumpled up. That's his problem, not yours. You run the red light. You get home safe. Thank God. Second day, you repeat the process, but today you're in your little Yugo. So you get up at 6, you go to work, you work all day, 10:30 at night, you get into Yugo, you get to the top, and the light turns red again. It's like a conspiracy. You get ready to hit the gas pedal to go through, just like you did yesterday, and then you remember, you're no longer in your Volvo. You're saying, what am I thinking? Guy on a bicycle comes along and hits me, I could roll off the road. So you stop. You're saying, what's this got to do with debt and equity and good projects and bad projects? Think of the red light as a bad project. Think of the Volvo as an all-equity funded company. Think of the airbags as cash cushions. Think of why you ran the red light. I protected you so much. You said, what could happen to me? Think of the Yugo as the same company, stripped off its cash, forced to borrow money, and think of why you stopped. You were afraid of getting hurt. I know this is an extreme way of getting your attention, but this is called the Jensen free cash flow argument for debt. But Jensen Alpha, he likes attaching his name to whatever he does, so this is the Jensen free cash, and he used it to justify LBOs in the 1980s. And to be honest, I didn't quite buy this as an argument for LBOs, because in LBOs, you don't just borrow money, you borrow way too much money. It's like taking your Yugo into the car dealer. And even Yugos come with, I won't say airbags, they're like air balloons, tiny little bags. You got to go forward to make contact with them. But taking it into the dealer and say, can you take the air balloon out and put in an air knife? This is a knife that, would you ever drive that car? He said, I can walk. Basically, you would never get in the car. That's what happens when you borrow way too much money. You put air knives into your, so every mistake you make could be your last. You're afraid to take any risk at all. Somewhere between the Volvo and the air knife is a happy compromise. And that's what you're looking for with debt. So when you think discipline, here's what I want you to think about. Every time you see a Volvo in the car, I want you to think debt and equity. Think the trade-off, because that's effectively what the free cash flow argument is. So let's take this argument and think about the implications. Let's suppose I came to you with 3 groups of companies, and I want to use this added discipline argument to kind of resolve which of these 3 groups you would expect to see borrowing more money. So this is purely based on the discipline argument. The first group of companies have very little debt and are privately owned businesses. The second group of companies have very little debt, but they're publicly traded companies with millions of small investors. And the third group of companies have very little debt, publicly traded companies with a Carl Icahn or a Bill Ackman on the board. So in which of these 3 companies would you expect to see debt as a mechanism for disciplining management? Let's start with the privately owned business. You own your own business. Do you need debt to discipline you? If you do, you're in big trouble. This is the least of your problems. I need to borrow money. This is your money. If you're taking bad projects, you shouldn't need debt to make you. So privately owned businesses, you shouldn't expect to see debt show up. So now comes the choice. Where would you expect to see more debt? Publicly traded companies with lots of small investors, or publicly traded companies with activist investors? There's actually, you say, activist investors force you to borrow money. That's because the life cycle part is coming in, right? But let's say they're at the same stage in the life cycle. If you have somebody big looking over your shoulder saying, you can't take that project, don't do that acquisition, you don't need debt to discipline you. Discipline is an issue only if I can't find something cheaper to discipline, because this is a very expensive way of getting your attention. So if you have lots of small investors, you're a Coca-Cola, you're a company that, even Coca-Cola is Berkshire Hathaway there, but if you take a company with millions of small investors, nobody is powerful enough to have oversight on you. This might be one of the few ways I can get you to pay attention to me. So tax benefits, added discipline. Let's talk about bankruptcy. Let's talk about the cost side. So those are the two big benefits. Let's talk about the cost. When you talk about the cost of bankruptcy, there are two issues you have to think about. One is the probability of bankruptcy. And that's going to be a function of how unpredictable your earnings are as a company. The more unpredictable your earnings, other things remaining equal, the less you should borrow. So if you're a cyclical company, you're a commodity company, you're a technology company, I would expect you to borrow less money than if you're a food processing company. But that's not the other half of the equation. The probability of default is purely a function of how unstable your earnings are. What's the cost of bankruptcy? Sounds like a stupid question, but what's the cost of going bankrupt? You're saying my money disappears. Remember, by the time you actually go bankrupt, that's already happened. By the time Valiant declares bankruptcy, this is going to be an extended scream into the night, right? It's going to be like 3 years of seeing my money knocked down. I'm not hoping for that, but if it does go bankrupt and I get nothing, it's going to be 3 years when my money went away. There are two costs associated with bankruptcy. The first is, when you go bankrupt, what exactly happens? You file for Chapter 11, right? And where do you end up? In court. Incredibly efficient place to end up, right? I still remember when I became a citizen of the United States in the 1990s, they must have been watching for this to happen, because 2 weeks later, I get a letter in the mail informing me that one of my duties as a citizen had opened up, inviting me to jury duty. And to show you how naive I was, I actually was excited about this. I circled the date on my calendar. I told my wife, remind me, I have to get there, my first jury duty. So I show up with a letter expecting balloons and horns. And there's this bored-looking woman sitting behind a table. She says, what are you here for? It's a jury duty. She says, go sit in that chair. I said, what do I do? She says, look at the terminal. So what am I looking for? Your number. I said, what number? She shows me the 6-digit number. So what if the number doesn't come up? She said, come back again tomorrow. I said, I can't keep coming back every day. She said, don't worry, we pay $8 a day. I said, that settles it. I'll come back for the rest of my life. But that kind of gives you an insight into how the legal system values your time and my time, which is at about $8 a day, if you're lucky. The only people in that building, that court building, whose time is valued are not even the judges. The judges get paid a fixed pay. They probably hope they don't show up. It's the lawyers. Everybody else there. I think if I restructure, anybody here from the law school? You don't want to admit it. Eh? If I redid the curriculum for the law school, I would make it 3/4 present value problems. Just to show people that if I have to wait 7 years for justice, I might as well get no justice. So that's where you're going to end up. You're going to end up in the court system, and it's going to suck up your cash like nobody's business. It's a study that looked at railroads that went bankrupt in the 1970s, which is pretty much every railroad. We talk about the aging of companies. Railroads went from 60% of the S&P in 1916 to being almost non-existent in the 1970s. So the study looked at how long it took after a railroad declared bankruptcy for creditors to get paid. You know how long it took on average? 7 years, very biblical. And only 50% of the assets of the company were available. You say, what happened to the other 50%? You can guess. My son actually works at Duff & Phelps at Morristown. So a couple of weeks ago I asked him, Brendan, what are you doing right now? He said, I'm working on the Lehman bankruptcy. I said, what? The Lehman bankruptcy? I don't even remember the name anymore. It was so long ago. But the Lehman bankruptcy was when? This is the gift that keeps on giving if you're a lawyer. The collective legal costs from the Lehman bankruptcy, this is its legal costs, exceeded $2 billion about 2 years ago. I hate to see what it's now. By the time this is all said and done, the people who are actually owed money from Lehman will get nothing. That's called the direct cost of bankruptcy. But there's an indirect cost. And here's what the indirect cost is. If people think you're in trouble as a company, are you in trouble? Let's go down the people. If your customers think you're in trouble, what do? They stop buying your product, right? You make cars, and I think you might not be around 2 years from now. What am I going to do? Park it next to my Studebaker in my, one of these days the part's going to show up. So first my customers stop buying my products. What do suppliers do? They used to give you 60 days credit. Now they've heard you're in trouble. So they say, give me cash. What do your employees do? They're checking out monster.com while they're sitting at the desk saying, I might not have a job 2 weeks from now. The perception of being in trouble actually puts you into even more trouble. That's called the indirect cost of bankruptcy. So here are my two propositions. The first is, if you have unstable and unpredictable earnings, I would expect you to borrow a lot less money than if you have stable and predictable earnings. That's an easy one. The second is, if you're a company with a lot of indirect bankruptcy cost, if the perception of being in trouble actually puts you into trouble, I would expect you to borrow less money than if you're a company without that indirect bankruptcy cost. You think, why would it vary across companies? Let me give you a very simple exercise so you can see why indirect bankruptcy costs vary across companies. Let's suppose you have three companies that have exactly the same operating income. So they have $10 billion in operating income. One company is a grocery store. The second is an airplane manufacturer, a Boeing, Airbus, a Bombardier. The third is a high-tech company. So they have exactly the same operating income. Put everything else to the side. Just think bankruptcy costs. Which of these companies would you expect to borrow the most money? I'll start with the easy question first. The grocery store, and I'll tell you why. First is, it's a non-discretionary item, so the revenues and operating income don't swing wildly. It's not like people buy 50% less groceries in a recession. The second is, think about indirect bankruptcy costs. I don't know about you, but I don't walk into a grocery store and say, is this a AAA rated grocery store or frankly, I don't care. It's not like a plan to bring the lettuce back 5 years from now, because if I did bring it back 5 years from now, I would hate to think what it looks like. There's no servicing needed, no follow-up services. Grocery stores can end up having horrible ratings and still survive. But think about being an airplane manufacturer. You know what a typical contract for Boeing looks like? It's a 15-year contract with Singapore Airlines to deliver 25 Dreamliners. There is no way Singapore Airlines is signing that contract with Boeing if we're a BB rated company. The perception of being in trouble for an airline can be catastrophic. So if you're Boeing, stay as far as you can away from that BBB rating because you cannot survive it. So you're going to borrow a lot less money and keep a bigger buffer because of who you are. And with technology companies, you have a different problem. Look how quickly you fall from grace as a technology company. 10 years ago, if I threw out the name BlackBerry in this class, people say, oh, that's a star company, a high growth company. And it was. 10 years later, it's a dead man walking. I don't even know. Does anybody here own a BlackBerry? Let's do a very quick survey. Oh, what do you have, BlackBerry thumb or something? You're addicted to it still? One person. So basically you can see how quickly you went from smartphones that everybody was using to phones that nobody uses. So technology companies, I understand when a Google doesn't borrow money. Or even when an Apple doesn't borrow money. You're saying, but they make so much money. You're one iPhone iteration away from blowing up, right? You know what I mean by that? The iPhone 8 comes out and nobody upgrades. There goes the bulk of your profit. So think bankruptcy costs when you think about how much a company should borrow. Let's talk about agency costs. You know what the essence of an agency cost is? You ask somebody else to do something for you. Notice that they never think as much about you as you do. So it's a group meeting, late in the evening. You decide to send me out for sandwiches. I'm part of your group. Incidentally, I've become the reply all on your emails. Be very careful. I've become part of your reply all in like 5 groups, and I'm listening in on all your conversations. So check to make sure I'm not in there, or if I'm in there, don't say mean things about me. That could be it could be one of those double agent games you can play where you leave me on and say really nice things on the side as if as if you don't know I'm there. Yeah. So let's say I'm in your group and it's late at night, you want me to go pick up sandwiches. So I go around the group and I ask you, what do you want, what do you want? And I get to you, and you're very specific. You say, I want turkey on wheat, no mayo, lots of mustard. I'm half listening. So turkey on wheat. And then I leave. I get to the deli. I don't even remember what you said. You say, ham on rye, lots of mayo, no mustard. What do I care? It's your sandwich. That's an agency problem. A classic agency problem that most of you probably don't face yet, or none of you might, is if you have kids and you hire a babysitter. Classic agency problem. My wife and I, when we had young kids, used to go out like 2 times a year. And you're going to see very quickly why only 2 times. Because yes, it was a production. 6 weeks ahead of the date, you had to line up a babysitter, backup babysitter, back up to the backup babysitter. The date would arrive and say, please God, let somebody show up through the door, even a serial killer. We just want to get out. So 7:15, the babysitter waltzes in. All prepared for the evening. I don't even know what that means. Big bags of whatever she's brought with her. So you turn the kids over. And you leave very specific instructions. We're just going to a restaurant. The kids have to go to bed at 9. And after 9, no sugar, no candy, basically just... So you leave and you go off to dinner. 9 o'clock rolls around. The babysitter's watching, I don't know, Gossip Girls or, episode just started. The kids sense weakness. So they come down, right? They come down in a group because they know that this is always more powerful, and they want ice cream and candy. The babysitter says, your parents said you can't have it. And the kids recognize that if they hang around enough, the babysitter's not going to be able to watch Gossip Girl. So they make complete pests of themselves. After about 3 minutes of this, the babysitter says, these are not even my kids. What do I care about them eating sugar? So take the sugar bowl up with you, take the whole, take the entire ice cream, go upstairs, don't come back down until I leave. So 10 o'clock rolls around, you come back home, you pay the babysitter, she's in a hurry to leave, you don't know why. She takes the money and she takes off. Then you hear the sound of kids hitting walls upstairs. You go upstairs, people are bouncing off walls, the sugar highs. And basically you write off that night of sleep and grumpy kids the next day. Now, when you go out, when you decide whether to go out, this becomes a cost you build into the system, right? Which means it's a cost, which means you go out less. You're saying, what's this got to do with debt and equity? You guys be the bank, we'll be the equity investor. Let's go borrow money from them. When I come to borrow money from the bank, or what should we say, safe projects or risky projects? What should we describe the projects we're going to take with this debt? You want to borrow the money. So when you describe the projects, you describe it as a really safe projects. I look after this money as if it were my own. And you're a trusting banker, as I said in the first slide. That's an oxymoron. You don't stay a bank of a very long, you're trusting. So you lend me the money based on the honesty of my face. So, okay, you tell me you're going to take safe projects. You lend us $2 billion. Now we have $2 billion of the bank's money. We told them we were going to take safe projects, but we're not people of honor. There's no contractual requirement. So what should we do with the $2 billion now that we have it? Let's go to the racetracks. Put $2 billion down in number 23. If it wins, what do we get? We get $10 billion. Or on Mississippi State against Yukon. I don't even know whether they were taking bets, but it's like 100 to 1. So if we win, we collect like $200 billion. We pay the bank interest, and we might even feel generous enough to throw a couple more percent to you. And we keep the remaining $197 billion. Of course, 99% of the time you lose. And if you lose, what do? You say, we're a corporation, we have limited liability. You can come in and take our assets. And what assets do I have? Absolutely nothing. That little tag that I got from the betting, you can have that if you want. This is an asymmetric game. You get the downside, I get the upside. Left to my own devices, what am I going to do? I'm going to borrow money and take risky projects. I'm going to borrow money and pay myself dividends. I'm going to borrow money and buy back stock if you don't stop me. That's why you're not a trusting banker. So when you lend money, what do? You write covenants. You can't do this, you can't do this, don't even think about doing this, don't even dream about doing this. If you've ever seen a small company borrow money, take a look at that loan agreement. It's a list of things you cannot do. The way I describe this is when you borrow money, you get put in a straitjacket. And the more money you borrow, the tighter the straitjacket gets. Should you care? It depends on who you are as a company. If you're Con Ed, you might not care. Why? Because you're a regulated utility, you're already in a straitjacket. You can't go out and invest in any business. So if you're a regulated utility, say, I don't care that I'm put in a straitjacket. But if you're Google, do you see why you might not want to borrow money even if you have the debt capacity? Because once you borrow the money, there's a ratings agency knocking on your door saying, why are you doing that? Those Google glasses, bad idea. Things you want to do, you might not be able to do. So when we talk about agency costs, it takes one of two forms. It takes a form of building in the cost, like I did in the babysitting, into the decision process, and a higher interest rate, in the case of debt. The other is what's called a monitoring solution. Let me give you the babysitter example. The way this would manifest itself is I put up cameras all over my house. And I watch the babysitter at dinner, so basically I can see what the babysitter is doing. That's a monitoring solution. That's expensive. In the case of companies, you hire lawyers to look over companies, and it's always the borrower who pays those costs. So if you're a company, one of the things I worry about is what that agency cost is. And again, life's not fair. For different companies, those agency costs can be very different. Let me give you two examples. One is a company that, no, in fact, I don't know. One is, in fact, let's take these three companies. Let's work through the agency problem. So what I want you to think about, all of you, is think like a bank. You have three companies approaching you wanting to borrow money. And I want you to think about which of these companies you're most worried about what they might do with your money. The first is a technology firm. The second is a regulated utility. The third is a real estate corporation. So when a technology company borrows money from you, what do they say they're going to do? R&D. How do you know they're doing R&D? They might be hiring people, putting white coats on them, making them walk around buildings, and look, we're doing R&D in there. You can't exactly look over their shoulders and say, that's not R&D. No wonder banks hate to lend to companies for things which have intangible assets. They feel uncomfortable. You lend to a regulated utility, not only are you lending to a company with predictable earnings and physical assets, you can see them. And there's something about real estate that I think makes banks' good sense go out of the window. The bigger the building and the more garish the building, the more money you lend me. I cover the building with gold, you lend me even more. I put diamonds everywhere, you lend me even more. Because you feel more secure because you see a physical asset. Which means other things remaining equal, if you're a company with a lot of physical assets, I would expect you to be able to borrow more money for the same operating income than a company with intangible assets. So when you think about agency costs, that's what I want you to think about, is how much trouble. So think like a lender. When you look at your company, would I lend money to this company and sleep well at night? And if the answer is no, you're either going to charge a higher interest rate or you're going to write in all kinds of contractual restrictions on me that get in my way of running the business. Which brings me to the last and final cost, which is every time you borrow money, you give up some future flexibility. And the more uncertain you are about your future needs for capital, the less you will borrow today because you have no idea what tomorrow will bring. So if you're a company with predictable investment needs, you should borrow a lot more than a company with unpredictable business needs. Which means you can already see that in businesses where things are changing a lot, you want to borrow less today because you have no idea what tomorrow will bring. So there's the trade-off. Let me close today by talking about what companies actually do. There are actually all these surveys that have looked at how companies, so this is the way you should pick debt versus equity. This study actually looked at what companies actually do. So this is called, basically it's a ranking of not what companies should do, but what they actually do. So when you look at companies and you ask them, when you borrow money, what are some of the factors you consider? Here are some of the things that they talk about mattering. They talk about maintaining financial flexibility. That's that, borrow money, put constraints on yourself. Long-term survival, that's another code word for bankruptcy costs. Predictable source of funds, because I want to go back to the same place every year and I want to make sure it's still there. Maximize stock price comes right in the middle. It's not at the top of the list. Financial independence, a high debt rating, and maintaining comparability with my peer group. So if you ask CFOs, what do you think about when you borrow money? These seem to be the factors they bring in. So let's set the trade-off up. So at this point, here's what we have as a trade-off. On the one side of the equation, we have the added benefits of debt, the tax benefit of debt and the added discipline. The other side, you have bankruptcy cost, agency cost, and the fact that when you borrow money, you give up some flexibility. That is the trade-off that's going to animate whether your company should borrow more money or less money. And I know it's qualitative. You say, how do I know whether it's 40? We'll come to that. Next session, we'll talk about the actual tools that will give you specific answers. But to me, this is the building block for thinking about debt, is thinking about that trade-off for your company. So let's end with that. When we start, we'll start with the quiz. So make sure if you're not taking the quiz that you let me know before 10:30 on Wednesday, and the review session tomorrow.
I think that's going to be a big factor. It's no longer like 10 years ago. Magic like this anymore. How do they market it? It's not about kind of business anymore. It's really about a way very different service. Already are. Because some companies they're able to low cost. Sometimes it's different because their regulatory overlay will always be light simply because they're not in the market. So some fintech businesses will be more affected. So what will happen is you start online credit. So, because PayPal is very paying, it's like a bank account that you can pay. So PayPal loans I think they start. So it's possible. PayPal you can get regulatory services. I can't let non-regulated companies use money get into service charges. So they take shipping costs. And that's starting to happen. So that's good luck. Oh, yeah. Bye.
They're different. I reflected if I took a case, I could have left the side benefits and side costs as separate calculations and compared the net present value of the furniture business to the net present value of not the insurance.
Building, existing one with building.
It's not like you're fixing it. So often very small private business.